Hi guys! Right, in this video, we're going to cover a question that's really important. It's usually or often how people get started in property. We're going to look how you can use equity to start to become a property investor. So, why would you want to get there? Well, it could be in your career path, you're a little bit frustrated. Who wants to work in a day job for the rest of their life? It could be that you want financial freedom, you want to create generational wealth, you want to be in charge of your own life, you want to live now, or maybe you're worried about a pension. I had all of those things that I was worried about, or not worried, but all of those things I had frustrations around. And I started in this classic route of taking equity to reinvest in property to get started. So that's what we're going to cover today, how you can look at using equity to become a property investor. Now, I'm Susannah Cole. I'm the founder of this YouTube channel. So you've got tons of playlists. You can look at sourcing, on raising finance, on lettings, on joint ventures, on deal packaging, investor books, all the rest on there. But also, I'm the founder of the Good Property Company, and you'll find a fantastic website stacked full of information, free live masterclasses, on-demand masterclasses, and downloadable immediate get ready to start courses, academies, and packs. So I do suggest you have a good look over. So let's come back to the question, how can you use equity to invest in property? Well, first off, what is equity? It's quite simple. The value of the house minus your mortgage, that bit's the bit you own. So the value of the house minus the mortgage debt on it, woohoo! The difference is your equity. And what's wonderful about that is you may have bought a property quite a while ago, and maybe you've been paying down on interest only. Maybe you've been paying down, or maybe you've been using interest only. But typically in the UK, capital growth means that the value of your property has really grown. So let me just come in with a disclaimer, if you like. I'm not FCA regulated. I'm not a financial advisor. I'm just giving you my opinion and my knowledge. What I really think you should do when you're looking at mortgages is work with a financial advisor, and then also have a good conversation with a tax advisor and your accountant before you get going on this pathway, because they will know your situation much better than I do. So shall we take a case example? If you bought a house at 300,000, and let's just say you only put down 10% as a deposit. So you put down £30,000 as a deposit. So the mortgage is £270,000. Great. But over time, and property on average doubles every 7 to 8 years, so this is a completely normal scenario, the value of your property has really increased. So now your property might be worth 500,000, but you only bought it for 300,000, you only put 30,000 in, and your mortgage, remember, was 270,000. So now you've got a property that went from 300,000 to 500,000. The mortgage has stayed the same if you were interest only, if you weren't paying down, at 270. So the equity has increased enormously. You're now at £230,000 equity, and you are itching to leave the day job. You want a better pension, and you can see that this equity pot could really be the starter to get you into property. It's exactly what I did. So for me, it's a route that was tried and tested. I absolutely think this is a great route for you to go forward.
So you can really see in that example of you bought it for 300,000, you paid 10% at the time, 30 grand, your mortgage is 270. It's now, with the kind of capital gains that we get so frequently in Britain, gone up to 500,000. So you've got anything up to £230,000 worth of equity to get started. It's the route, like I said, I started with them. So you've got three options. In order to pull out equity, you can do 1, 2, and 3 option. Option number 1. You can refinance onto a different mortgage. So you would leave mortgage number 1, thank you very much. You would apply for and be successful in getting mortgage number 2. So that mortgage was 270, maybe you got, I don't know, 450 or something. And out comes the money, and the balance gets put into your account. Typically, you'll probably look at doing that when at the end of the current mortgage, the fixed term, so you're not paying any redemption fees. Option number 2, you've got the original mortgage at 270, you want to get, I don't know, 450. So you're like, well, we'll leave mortgage number one, company A, and I'll apply for a second mortgage on with company B. So you end up with two bits of lending from two different lenders. One will be a primary mortgage and one will be the secondary. And again, the money comes out into your bank account. Your loan is bigger, your equity is smaller because the cash is now in your bank account. Or alternatively, you've got option number 3. You keep the original lender, mortgage company number A, and you say, hey, look at my equity. And they've got what's called a further advance scheme. And you will apply for an additional loan from the same lender, which they'll add on to the original mortgage. And then same thing, the money comes back out into your bank account. So in essence, there are 3 different ways of you being able to get the equity out of your house into your bank account. So what would be the process? How would you go about starting this process? Well, you would work with an IFA, independent financial advisor, and they would do what's called a DIP, a decision in principle. That is a soft search on your credit score, so it doesn't leave a mark, which is great, so it doesn't impact on your credit score. And that kind of gives you the comfort or the security of knowing that you are highly likely to be awarded this mortgage. So you're not kind of, oh golly, I've gone and found a house, but suddenly I can't actually get the funding that I want to get. I used to do DIPs, decision in principles, all the time in the early stages of my property investing career because I wasn't quite sure at that point whether I would get mortgages, and it felt much more comfortable knowing. So in the early days, I definitely recommend doing that. In this scenario, you've decided that you want to go back to a relatively high loan to value. You've got the financials to be able to back it up, so your salary coming in, and you're going to look to get £450,000 out of this £500,000 house, and your mortgage was £270,000. So you would proceed with a DIP, and you'd be looking to get £180,000 cash out. The next stage would be that you pay for a survey and an application fee, of course, and then you typically also have to pay for the lender's solicitor's fees. They will give you an offer in writing. Now, you do need to look out for any special conditions because occasionally there are some, sometimes there aren't, and then you need to satisfy those special conditions. So you then proceed with the paperwork by evidencing your income, evidencing the value of the property because you've paid for the survey, and they will give you out the offer. At that point, you sign the offer, and your solicitor does the work or the solicitor, depending on whether they have a solicitor that they get you to pay for directly, and then you pull the money into your bank account, having landed your new mortgage. So now we have a scenario where you bought it for 300,000, you had a 10% deposit, 270,000 was your mortgage, it went up to 500,000, you've decided to stick at a higher loan to value, again, same loan to value, so you've remortgaged for £450,000, and the balance, 450 minus 270, 180,000, lands into your bank account. Then you're going to use it to buy investment property. Now, this video is not talking about buying investment property. This video is walking you through the step-by-step process to get the equity out of your initial property in order to be in a great position to buy that investment property. So you have released equity of 180,000, but remember there are some fees. So let's assume the fees are £5,000. That means £175,000 has landed in your bank account. Great. Now you decide to go out and you buy investment property, and you decide to split that into 2 lots of £50,000 for a deposit at 75% loan to value. That means that 25% of the property's value you'll be paying for in cash, 50 grand and 50 grand, and 75% will be paid for on a buy-to-let mortgage. So 150 grand and 150 grand. Remember, you had 175,000, so we still got 75,000 put aside. That will then do some of your renovations, plus be a bit of a safety net, because I don't want you down to nothing. Okay, guys? So maybe you have renovations of 20 to 30 each. So you've still got between 35,000 and 15,000 pounds as a safety backup. And you always want to have that in property, a bit of a piece of working capital in case of any emergency. So you've now got your original property worth 500,000 with a mortgage of 450, so 50 grand equity. You've got property number one worth 200,000. Of course, you've bought it discounted, but that's another matter. So it should really be worth 300,000. But let's just say you got it at price with a 50,000 pounds a deposit, and you've got property number two worth 200,000 pounds with a 50,000 pound deposit. So you've got two rentals. You can do those rentals single let, service accommodation, or multi-let. Single let is probably the first property you do. Start off with a single let, but I like to do service accommodation or multi-let because you get much higher yield and much more profit. And I want you to get at least 10% yield. Now, if you don't know that, yield is annual rent divided by purchase price. The estate agents will tell you 5% is amazing, 6% is astonishing. Nah. Rules are it needs to be over 10% or you don't touch it. So let's assume that both of these £200,000 properties are going to be an HMO, which is a shared house, which is probably, you might do professionals or you might do students. Now, typically my properties that are HMOs are making over £1,000 a month each, but let's be cautious and say you're making between £750 and £1,000 per month profit after all costs for each property. Now that's looking quite tidy already, isn't it? So let's continue with the numbers and stick with me, because here's the really great news. Each of those HMOs is making you £1,000 profit after all costs. And typically you've got management cost, maybe about 15%, repair costs about 10%, and then just everything else, kind of insurance and all the rest of it. But after all costs, they're making you £1,000 each. So £12,000 each per year. You've got two of them. They're making you £24,000 profit. Nice. But hang on, you've had to take out some extra borrowing. You took out £180,000 extra borrowing from your original home, probably your own home. Now that may be costing you in the range of kind of £7,000 to £9,000 if, and that's quite an expensive mortgage at time of filming. So let's just say it's £8,000 cost. So it cost you £8,000 in extra interest, but you're making £24,000 more. So after all costs, you're already making £16,000 more profit per year. Plus, you've now got three houses, not one. You've got your initial house bought for 300. As we know, capital gains gone up. Now it's worth 500, continuing to go up. How good is that? And now you've each got an investment property worth £200,000 and £200,000. So another £400,000 worth of property. So you've got £16,000 worth of profit after paying for the additional borrowing. And you've now got £900,000 worth of property. And as we know in Britain, typically, obviously not always, property goes up and capital gains is really where the big gains are. So you're winning on the profit, in the cash flow profit, and you're winning on having a larger asset base, which typically is going to go up very significantly. So in one move, we got a really nice scenario, haven't we? And of course, there's things you need to do. Of course, you need to learn how to let, you need to learn how to be a landlord, you need to know the legislation, but there are professional associations for that. And actually working, if you have upper quartile properties, you tend to get upper quartile tenants. It tends to be an enjoyable working relationship. So yes, it's not that simple. But what I've done is, first off, I hope I've pushed your expectation from I'm going to buy one more property to now let's go for two minimum. And then secondly, I've really shown you that using a high yielding property, your cash profit every year increases, but also your asset base increases. And of course, what you'll do is you're like, woohoo, let's go again, please, as those properties go up. So I've shown you the bare bones of the structure of why you want to probably look at taking equity out of your own home, reinvest in investment properties, growing your net wealth, your asset base, growing your profit, your cash coming in. And if you're savvy in the early days, that whole delayed gratification, you take that money and then you go reinvest in another property. It's a beautiful system that, if you get it right, stay well managed, can really grow your wealth and get you to financial freedom really quite quickly. So it's exactly the route I took, and I would so love it if, after taking professional advice from the right qualified people, you decided to really go for that strategy. You will be so glad you did it 20 years from now. So I hope by following this example, you can see the principle of taking equity out of one property to reinvest into minimum 2 more properties can really help you in the long run become financially free, live life on your terms, and maybe if generational wealth is what you're looking for, you'll be on your way to developing that for your family. So remember, like, subscribe, somewhere there'll be a button. And in the little ending of this video, there'll be something for you to download, whether it's free or whether it's super useful for you. And have a good look at both my YouTube channel. I've got playlists that are beautifully organized for you, and you can find how to find those discounted properties, because we didn't even talk about discounted, but also have a look at my website. It is called thegoodpropertycompany.co.uk. It is stacked full of immediately downloadable education for you, which will really help you along this journey. But the most important thing is take action, get educated, and then good luck to you. Click down here to download it now.